Self-storage markets. Well, markets in general when investing in real estate, they obviously impact everything, and the strategy in each is different. So today, I'm going to give you a breakdown of my 4 classifications of self-storage markets and how to work within each, the pros and cons, and the strategy that correlates with each of them. Let's start out with defining these markets. That is something I found is largely misunderstood. So some people want to classify them as second tier, first tier, third tier, fourth tier, fifth tier, which I do, and I understand that people do. Here's the problem. What a second tier is to one person is not what it is to another. What does that mean? And how is that impacting me and my strategy? Let's run down the market tiers. First tier markets are large metropolitan areas with populations much greater than 1 million people. For example, Los Angeles, New York. Second tier markets, smaller MSAs with populations more like the 500,000 to million. Let's use examples like Austin, Texas and Charlotte, North Carolina. Third tier markets, we're going to classify as smaller cities or towns with growing economics of population, 100,000 to 500,000. A classic example of a third tier market would be like Reno, Nevada. Fourth tier markets. Fourth tier markets are small rural towns with population less than 100,000. When we look at the markets, I classify them more as they relate to the importance of my strategy and what we're doing. I'm going to go through each one and tell you what I call them, and then we're going to define them. First, we have declining markets, we have stagnant markets, we have growing markets, and we have booming markets. These two are broken up into 2 sections, and they are defined by certain attributes. To understand what makes a declining, stagnant, growing, and booming, there are 3 main factors that I am looking at to define these. So the first factor is population growth. Number 2 is income growth, and number 3 is sustainability. The major input for sustainability is infrastructure. A lot of people look at this and try to decide what is good and what is not, especially when we get in the middle here. Defining these things can be tough, depending on where you're at and also your perspective on what a booming market is. So let me break down the major drivers of what I'm talking about. Inflation tends to be my defining factor. What I mean by that is generally population growth and income growth that is above inflation rates generally create growing and booming markets. When you have population growth and income growth that are below inflation rates, you start to get stagnant and declining markets. We see that. We see population and income that aren't keeping up with inflation, and they start to look old and deteriorated, and your buying power starts to get lost. This is not a hard set rule, but in general, I'm looking at something like around 1 to 2%. Something in stagnant, more like negative 0.5 to 1%. It could be even a little over that, but not much. And then declining is sustained negative growth. Booming, generally 2+%. Those markets are generally growing past the inflation rate. So everyone's buying power is more. You can replace things because it's worth replacing those buildings, adding new products. There's escalation, right, in both growing and booming markets. When you look at declining markets, stagnant markets, growing markets, we all need to remember that markets do this, okay? So a short-term growth and a short-term decline doesn't equal long-term growth or decline. That is why the third one is very, very important, sustainability. Generally, when I'm looking at sustainability, I'm talking infrastructure like airports, freeway systems, economic inputs that have diverse, growing businesses. There needs to be a reason for that growth to be there that will continue to drive income and population to come. A perfect example is where I live, which is Boise, Idaho. Up until 2008, I think you could argue that the sustainability of Boise was in question. Right before 2008, there was a big burst of growth in the early 2000s. A lot of infrastructure came with that. That is why it recovered And since then, it has been on a tear. Other places that we know that are booming are places like Nashville, Phoenix, and pretty much all of Texas, right? These are huge booming markets. And some of them are growing in ways that others can't. Also, I should note, I view markets like a solar system. You have the sun, which may be one big market. You have all these other markets around it. Other markets that can utilize the power of this big market, they have sustainability. They're utilizing the power of the sun, right? And they grow from it. The more isolated a market is, the more risk you have that it is not sustainable because it doesn't have infrastructure in place. That was frankly the problem with Boise. Texas is a perfect example of this. You have a bunch of big markets that are sustainable on their own, and then everything in between is blowing up and growing. So although a small market in Texas may not have all this infrastructure that we're talking about, well, its proximity to ones that do create a sustainable environment for population, income growth, infrastructure to continue growing, etc. We must mention that each one of these does have pros, and each one of them does have cons. I'm not saying that one necessarily is even better than the other. I have seen assets that someone have bought in a declining market that have outperformed assets in a booming market. Understanding risk is very important when it comes to growth. You would assume booming markets have less risk, but that's simply not true. In fact, a lot of aspects, they have greater risk. So let's roll into the pros and cons. The general pros are, we have value, both extrinsic and intrinsic. If you haven't seen my videos on extrinsic and intrinsic value and how we come up with that and what that means, please watch this video here. But in general, extrinsic is simply price. It's the price of the asset. Intrinsic is what that asset does, what it produces, that revenue that it produces. Two very different types of value. That affects markets wildly because in markets that have growth, the market itself will drive value through extrinsic forces, meaning that prices are going up, things are worth more, and there's more demand because you have more population and more income. Once we go into stagnant and declining markets, your value should never be planned on extrinsic factors like equity and price rising, because you don't know that it'll be there. Value from these markets are generally derived from intrinsic things, and when we say that, we mean larger cash flows because of lower extrinsic prices. So it's a cash flow play. There's an assumption with real estate that you buy it and it goes up in value. And this assumption was driven home in the last 3 years when you even had down markets and declining markets and values went up because investor demand was so big. But then interest rates went up, and when money gets tight, money leaves here and goes here. When there's lots of money, money gets pushed out of here and goes down here, driving up prices. Now we can talk about the cons. When you're in this market, demand is not known and it can be very temporary, and it can go away for a long time where you literally don't have buyers. That means the extrinsic value is a risk, especially with storage. Many times up here, your intrinsic value is at risk. That's due to these markets have lots of people coming in, and there is lots and lots of building. Oversupply is a big deal here because people are building for future demand. That means if that demand stops because you go in a slow time like growth rates, there's way too much supply and the ability for that asset to produce revenue starts to drop. So you can see those risks and value are counter opposites of each other. Prices can also be a big con. You're paying for the future value. It's harder to get workers. Everything is inflated. Now, down here, the cons are very much the opposite. Lack of growth, lack of future options and potential. The bottom tier of this, you have the eroding effect of your dollar. We see assets in declining markets that are trading at multiples below replacement cost. That means if you had something happen to a building, the rent you're getting doesn't even pay to have it be rebuilt. You can't generate a profit if you had to replace the building because rents are so low. They're actually going backwards. The further away you get from the center, the further risk can get. Up on top, you run into speculation, and down below, you have eroding fundamentals that you can't get out of. All right, now let's talk about strategies. Once again, strategies follow the opportunities, the risks, the pros, the cons. Generally speaking here, you get your value when you buy. My strategy here does not include an equity conversion event. Meaning, when I buy in a market like this, I expect to go years where I might not be able to get that increased equity or value that I built in out. I don't know if I'll be able to sell it. I don't know what price I'll be able to sell it at. I don't even know about the refinancing options and availability of that like we see today. So it's solely dedicated to cash flow, what I can do with the asset. You've heard me talk about money on the table. All value is when you buy, because it's what I can measure. I'm looking at buying an asset that I can see everything that's going wrong. Do they have delinquencies? Are they under market rates? What are all the things they're not doing right? But I know that if I expect to sell that for a profit, I could be sorely disappointed. So I do not want to make a plan around that, and I need to be happy with that equity that I create and that I'm getting from my cash flow. It's really, you got to play that game. There's a lot of risks. It doesn't mean that it won't happen. It doesn't mean that you can't sell. It doesn't mean that you won't be able to refinance. It doesn't mean that at all. But it means that when times are good, you will be, and when times are bad, you might not have any options. So that equity part that you're looking at, you need to have lots of time. As markets go through cycles, when the markets are really good, that's when you're going to want to take advantage of that, because that may be your only time. So time is your friend. Lock in those interest rates for really long periods of time. Don't expect to flip. Don't expect to turn around. That market can turn on you, and that extrinsic value is in question. All right, top. We're looking at much tighter pricing cap rates. Generally speaking, my personal strategy is this. Right about the line, I am buying, I'm building, and I'm avoiding. I want to buy, and in a growing market, I get both intrinsic and extrinsic potential, and those two things are what I look for in acquisition. It's really hard in booming markets for me to buy at many points in the cycle. A good way to look at this is, for the last 3 years, starting in 2019, we started to go further down out of the food chain here, much more into the middle. Now today, as interest rates went up, our acquisitions have now gone back up this way because the extrinsic part of that booming market has gotten hammered. Therefore, I see an opening into a high growth market without having to involve speculation. I'm playing with risk. I don't want lots of risk. I don't time markets, but my money does. Many times in these markets, we like to build because building is at a discount to buying at sometimes multiples. I can build for $100 in this market, where in order to buy, it would cost me $300. Now, when we go back down here, it is really important that your strategy involves a large margin cash flow, that you're looking at markets that are vastly underserved. You have huge risk with anyone that builds. Up here, you have oversupplied from lots of people. But down here, markets can get oversupplied with just one person building. Those markets may never recover. I say this as a warning because many times beginners go straight down here. This is where I started. I started in stagnant markets. I could get in and I could buy off cash flow. That to me was safety. The reason being is I was not good at underwriting. I wasn't good at evaluating risks. So when I could measure exactly what I was buying and I had good cash flow, that made a lot of sense. I had to work very hard to make sure I understood the market, make sure that there was no new supply coming in, and make sure it wasn't a dying market. I'm not against it. I am against declining markets. All right, we understand the overall risk outlay are two divisions in the markets: what works, what doesn't, strategies in general that need to come along with it. That is my breakdown of how I view markets, the strategies, the risks, plus the advantages that come along with it. Let me know below, tell me in the comments, where are you targeting? What markets are you in, and what's your strategy in those markets?